On this Melbourne Cup Tuesday, the RBA board met and they've kept interest rates on hold for another month. Now, there's been a lot that's happened in the last month, and I'm going to spend a few minutes talking about that. The first thing we saw was an out-of-cycle rate rise for mortgage holders. Most importantly, not business lending, just mortgages. That's the sign, and I'll come back to that in a minute. In addition to that, we're seeing the second-tier lenders and the other lenders that are now following suit. And the ones who haven't announced, trust me, if you think you're getting a better deal, they will move rates up higher. Now, why have they done that? Well, they've talked about the need to have a strong balance sheet. We've talked about APRA in terms of wanting the banks to be more financially secure in the top 25 of lending institutions around the world. They want to see that happening. And so part of that process has been about strengthening the balance sheets. So they've gone out and done capital raising, and now they've also asked their mortgage holders to actually pay for a bit of that capital raising and strengthening their balance sheets. So that's one argument. But the other argument is behind the scenes. What's going on behind the closed doors? We're seeing APRA coming out and restricting borrowing power. So the Reserve Bank certainly want to have the opportunity to be able to adjust rates if they need to. Okay, but they need to get all of their ducks lined up. I've said this to you before. When you've got low cost of funds, it does start to see asset appreciation because the cost of money and borrowing becomes easier, and that does push asset prices higher. But they simply don't want this to occur in the residential market. All right, we don't want to see further strong growth in residential prices, and that's important for the sustainability of our economy and our overall economic output. If we have a correction and a big correction in the marketplace, that's going to affect sentiment, and there's going to be financial ruin around the place in regards to what would happen, because it changes buyer sentiment and people start to move into their shelves and don't spend anymore, and that hurts jobs. So it's really important to understand that this move is a sensible move. So even though rates are on hold and we saw a low inflation number last week that gives the bank the opportunity to drop rates further, we're actually still on hold. So they've said, let's just wait and see, because inside the economy, we've actually seen some positive signs. Business confidence is a little bit stronger. Consumer confidence is also up. Inside the Westpac survey, one of the interesting things in that was they asked people around unemployment and their confidence around their job security. That number has come down significantly, which means people feel more comfortable in their jobs. So those types of factors are playing out to see that there is some real confidence around the general economy outside the mining. A further support of that is around some of the numbers coming out around capital expenditure. We're starting to see good capital expenditure outside of mining and manufacturing, and that's a good sign. And I come back to that point before. You notice that they changed interest rates in regards to residential lending, but they didn't touch business lending. And I suspect that if we do see another rate cut, you're not going to see it from a residential point of view. So we've seen around 15 to 20 basis points higher in terms of what we're now paying as mortgage holders. If we do see a rate cut, what will happen is we definitely won't get that full 25 basis points passed on. But it will be passed on to businesses, and that's an important message, because the business community is what's going to drive us out of this into stronger economic activity and back into that nice sweet spot of around 3% economic growth. So inflation's in check. There is capacity for the Reserve Bank to basically make those changes. So there will be some considerations around interest rates to the negative in terms of reducing interest rates, but don't bet on it from a household point of view. Okay, they've done enough for the household sector and in terms of building approvals and construction in the residential sector. They now want business to come to the party. So if they do move rates, it's all going to be a story about the banks passing that on to businesses. So business lending becomes cheaper and the economy starts to move outside of this, residential construction building component that's already been set up. So it's interesting times, rates on hold, but there will be some changes in, I think, the coming months if we still don't see that business activity getting stronger and stronger. If we see that business activity start to flow through in the numbers, then I suspect rates will be on hold. But there is move for a move down, and we'll just have to wait and see what happens next month.